Hi, I'm Ed Hendricks, and the issue I picked was the ethics of the mortgage industry in the early 2000s. Um, so I want to go over that. Basically, it did not start out as an ethical issue. It started out with trying to be helped. So the ethical question was, did the greed of Wall Street cause the housing crisis? And its perspective from a mortgage banker, as I was a mortgage banker for 15 years. So I basically lived through this, worked through it, and kind of have a different view than a lot of people probably have on it. Basically, the biggest problem that we had was, and it's not really a problem, is during the Clinton administration, they decided that everyone should own a home in the United States. Not a bad thing. The bad and the problem became once Wall Street and banks decided that, hey, there's a lot of profit to be made in this. And once there's profit to be made, that's when greed sets in. So a lot of it started with the automated underwriting. What had happened is banks had set up subsidiaries of themselves for a subprime market. They didn't want to be tied to giving loans to people with lesser credit than what their banks were actually giving them. But in this case, Chase, Citibank, Bank of America, a lot of these places had subsidiaries that went under different names so they could give loans to people who, at that point, banks decided did not deserve to have loans. So they came up with automated underwriting. What automated underwriting did was you typed everything into a computer, you hit submit, the computer would come back with findings and tell you if someone was approved or not approved. Great idea, other than the point of you could go in and manipulate assets for people to give people loans who probably did not deserve loans, be it FHA loans or even conventional loans. The types of mortgages that were then being offered was Wall Street came up with different types of loans. The banks and Wall Street worked together, and they would come up with the different types of loans that were being offered. Interest-only loans were some of the biggest loans that were being offered out there at the time. What that basically would do is you would borrow, say, $350,000 to buy a home. You paid only the interest every month. What would happen with the rest of your money that was not being paid, your principal and interest, or your principal, it got tacked to the end of your loan. So then you went to refinance. What would happen is if you borrowed $350,000, you may owe $500,000 on a home that's only worth $350,000 to $400,000. This then came into play with appraisers. Appraisers would basically give you whatever value you wanted. You told them you needed this amount. They went out and they had a lot of leeway of where they could go and find different types of comparables, which are other homes that sell that are similar at the same price. Usually you're supposed to stay within the neighborhood. They were going outside the neighborhood. Everybody's, guidelines became stretched, what they would allow. Being someone who worked for a mortgage banker itself, I saw appraisals that would come in where they went to other cities actually to find comps that were comparables and said they were in another city when they weren't, and then they would get caught. So this actually inflated a lot of property values all around the nation. And then what happened is when people went to refinance or they became upside down in their home and wanted to get out of that mortgage or sell their home, they couldn't. So the crisis then started to come out. Paperwork that was sent. Paperwork was sent through the mail through most places. With my company, we actually went out with each individual, sat down, went over the paperwork, the preliminary paperwork, had them sign it. If we got to the closing, which we typically did, you sat down with a title agency along with myself or someone from my office would sit down at the closing and go over and make sure that the customer knew every piece of paper they were signing and were good with it. If there were questions, we tried to answer them at that point. We tried to make sure everybody knew what they were getting into. Paperwork was sent through the mail with a lot of different companies. They either emailed it or they mailed it out to you and overnighted it to you. The customers would then sign it and send it back. The problem being is it wasn't explained to a lot of customers that what they were signing. Was it a 2-year fixed and then the other 28 years became a variable, 3-year fixed and variable, interest only? Customers not knowing, not being educated, not having a chance to question it, would just sign the papers and send them back. This caused a lot of problems early on. People would go to refinance their homes or to get out of their 2-year fixed, and they couldn't do it because their payment would jump up dramatically, or they were upside down in their house. That goes into the terms of the loan not being explained. Was a huge problem. Do I have a 30-year fix? Do I have a 15-year fix? Do I have a 2-year fix with a 28-year LIBOR? Do I have a 3-year fix? Customers just weren't clear and hadn't been shown what exactly they were doing. Mortgage companies were making a ton of money. What was happening is you did loans, A plus, A, B, C, D, right down the line. The worse the credit, the worse grading that you got. What was happening, and I saw this from a personal standpoint, one of the companies I worked for, at the end of the month, they would sign off on conditions, it basically waive conditions, so the loans would close. They would have a bundle of, maybe they were getting their most money that month off of A plus paper. They would take loans that were graded as B or C and slide it into the millions and millions of dollars worth of A plus paper they had and sell it off. So they were actually making a lot more money on loans that they should have not been, based off of what the other companies were paying them, the people on Wall Street, for mortgage-backed securities, in the yield spread that they were making. So they were making millions of dollars and making more money on loans that they really didn't need to be making on. And this is where the greed set in. As this was happening, Wall Street was making money. And then insurance companies on Wall Street would also work with the companies on Wall Street to let them know, hey, you buy this insurance and we'll make sure that if any of your loans go default, you won't have to pay on them. You have the insurance, we will cover that for you. Huge downfall of what started to crumble Wall Street when the mortgage came to a halt. Who was affected by all this? Obviously, current homeowners were completely affected by what was going on with their homes. Where their homes were worth too much. They were upside down in their loans. They had loans that they couldn't afford anymore because they had the variable rates had become. So a lot of houses then, basically people were walking away from their homes and going into foreclosure. Future homeowners were greatly affected. Why were they affected? Now trying to go get a home loan, subprime market has gone completely out of business. Back in, I believe it was around 2008, 2009, all the subprime lenders closed their doors within a 2-month period. Sitting there watching, we would get fax after fax after fax of all the companies that were closing their doors and were no longer accepting loans. They were out of business. So to get a loan, you basically had to have pristine credit, and even people with pristine credit and going through FHA, VA, more and more hoops came up. The banks wanted to make sure they were not going to lose money and could, if they ever had to foreclose on a home, could resell that home. Basically, appraisers were assigned to your loan. You did not get to go pick your appraisers anymore. They were actually assigned by the lender to go out and do the appraisal on the home that you were requesting a loan to be done on. Once that happened, mortgage companies altogether, they were affected by it. As you could see, mortgage companies started going out of business. FHA started losing business because you just could not get loans for customers anymore. The U.S. economy took a huge hit. Wall Street started to crumble. Lehman Brothers closed their doors. Once they closed their doors, it was clear that the Wall Street was in serious, serious problems. So the government had to come in, pay money to save some of these companies. The government was forcing banks to buy other banks at pennies on the dollar to keep them open, or to buy up their shares to take them over. Also, insurance company, a big insurance company, which I think everybody knows who that was. Also, the government came in and rescued them also because they were the ones offering the insurance on the mortgages that had all gone default on. Other countries took a hit too. Countries were coming in and buying up our mortgage-backed securities. Once that happened, when the housing market hit and the crisis hit, they were out their money. They couldn't make the call to get this money back, so they were stuck with basically paper that was worth absolutely nothing. So in conclusion, what basically happened here was a lot of money was being made for a very large period of time. Wall Street was then making programs to help customers. Perfect example was if you had a 580 credit score, which is a very low credit score, one day out of foreclosure, one day out of bankruptcy, at that point you could get 100% financing on a home and buy a new home. Basically, customers were coming in, they had wiped out all their debt, and now we're buying homes much bigger than what they originally had and have gone foreclosed upon. So if you had a $60,000-$70,000 home, you went foreclosed, you got it foreclosed on, you came back and you bought a $250,000 home. Basically what was going to happen in that case. Ethics came into play a lot with myself and the companies I worked for, of giving the right loans to the right people and making sure they knew what they were getting into, and not looking to just make the most money off of a customer. If a lot of people would have done this overall, probably a good idea, a good thing that this may not have happened, but unfortunately it did happen. So that was the case that I did. I appreciate you listening to me, and hope you enjoyed it. Thank you very much.